Welcome back to our next session on reflections on investing. And we're still dealing with the question of whether the stock market is too high. So let me review where we ended last time. I was using the basic valuation equation. Just writing it down one more time. And so on. And these C's had come from Damodaran. And the risk-free rate was 1.6%, the 10-year Treasury bond rate. And the S&P 500 was 4,200. And we solved for the risk premium, which turned out to be 4%. So the question of whether the market is too high amounts to whether a risk premium of 4% is enough to satisfy investors. Well, historically, can we look back and see whether or not the risk premium has been more or less than that? And we can. And here is a line showing the risk premium over all the years from 1961 through 2021. And you can see in recent years, the risk premium has averaged about 5.5% before diving down to the current level of 4%. And remember, the risk premium diving down is the market jumping. That's why we're at this record level of 4,200 on the S&P 500. But 4% is not unprecedented. Back here in the 60s, it averaged about 3.5%, and it got as low as 3%. And it was even 2% during the dot-com boom. So, in asking whether the market is too high, the answer is sort of, well, maybe, maybe not. Depends on what you think about the 4%. It's low relative to 5.5% in recent years, but it's higher than some past historical episodes. However, what investors are ultimately interested in is not the risk premium, it's the risk premium plus the risk-free rate, and that's about 5.6% currently. How does that compare historically? Well, here's a chart that shows you the expected return on stocks, which is the sum of the risk premium, that's the red, I'll just call it RP, and the risk-free rate, that's the blue, call that RF. And you can see that because Treasury rates are so low now, the sum is as low as it's ever been. So right now, the expected return on stocks is as low as it's ever been in the last 60 years. That makes you think maybe the market's a little high. On the other hand, maybe we know how to handle the economy better, and investors no longer demand the same risk premium. I want to end this session, though, by showing you how sensitive the level of stock prices are to the risk premium. So let me go to a new page here. Right now, the S&P 500 is at about 4,200, and that's consistent with a risk premium of 4%. Well, I said that we're going to look at two alternatives. One is that the risk premium goes back up to its recent historical average of 5.5%, and the other is it goes all the way down to 3%, a level touched in the 60s and during the dot-com boom. Well, if the risk premium goes back to its recent historical average of 5.5, the stock market is going to fall a lot, all the way down to 3,061. On the other hand, if it were to drop to 3%, not unprecedented, the stock market would rise to 5,663. So you can see how sensitive the level of the market is to the risk premium. So whether or not the stock market's too high depends upon whether you think the risk premium is right or whether you think it's going up or going down. So that's the thing to keep an eye on. Ask yourself how much investors need over the risk-free rate to hold common stocks, because that's what's going to drive the market going forward. This has been Reflections on Investing. Thank you.